With the world economy seeming ever so uncertain, it's difficult to decide where you should ideally be parking your money. With everyone from financial gurus to financial publications painting a doom and gloom scenario, finding a safe investment option that will also grow your money, even if by a little, is something that every retail investor is looking for. Which is where we come in. We hope that some of the safe options we are suggesting in this video will help you navigate the choppy waters of investing in 2023 and safely land you to the shore by the end of it. So here goes. 1. Index funds. Index funds are a form of passive investing, which means they are designed to track a specific index or market. By investing in these, you can achieve diversification across different asset classes, industries, and countries. This diversification reduces your risk of losses due to market volatility or specific economic events. Index funds typically have lower management and transactional fees than actively managed funds. This is because they don't require portfolio managers to research and select individual stocks or bonds, which reduces their overhead costs. This means that your investments will remain relatively unchanged unless the index changes. This passive approach to investing also reduces your risk of losses due to per-stock selection or timing. 2. Exchange-traded funds. First, exchange-traded funds, also known as ETFs, trade on an exchange and are priced throughout the day, so investors know exactly what they are buying and can easily monitor prices and make trades. Second, ETFs are typically passively managed, meaning that they are designed to track the performance of an index or group of stocks. This means that the risk associated with these are pretty low. Third, ETFs are also highly diversified, which means they contain many different stocks and/or other investments. This helps to reduce risk because it mitigates the chance that any single stock or investment will cause losses. Finally, they are tax efficient as they are typically structured as a pass-through entity, which means that investors are only taxed on their gains. This helps to reduce the overall cost of investing and can help investors keep more of their returns. 3. Government bonds. These are debt securities issued by a government to raise money to fund a variety of projects and activities. They are considered safe because they are backed by the full faith and credit of the issuing government, which means that it has the ability to raise taxes or other sources of revenue to repay investors if necessary. Additionally, government bonds generally provide a steady stream of income in the form of interest payments. Furthermore, they are considered low-risk investments because the government typically has a strong credit rating and can be expected to pay back its debts. Finally, these bonds are often tax-exempt, so you as an investor do not have to pay any taxes on the income earned from the investment. This makes them attractive to those looking for tax savings. 4. Certificates of deposit or CDs. These are a safe investment option because they are insured by the Federal Deposit Insurance Corporation, FDIC, up to $250,000 per depositor. This means that if the bank or financial institution fails or is unable to pay back the money you have invested, the FDIC will step in and reimburse you for your losses. CDs also offer a fixed rate of return, so you know the exact amount of interest you will earn on the money you've invested, which is great news for anyone who is wary of volatile markets. Additionally, CDs are a great way to save for retirement. They offer a guaranteed rate of return. Another positive is that since they are not subject to market fluctuations, you don't have to worry about your investments losing money if the market takes a downturn. Finally, CDs offer the flexibility of allowing you to choose the length of your investment. You can choose to invest for as little as 1 month or as long as 5 years. 5. Money market accounts. These are a type of savings account offered by banks and are a safe investment. They offer higher interest rates than traditional savings accounts, but with FDIC insurance up to $250,000 per depositor, per institution, they offer the same security as a traditional savings account. MMAs allow for higher liquidity than other investments. You can make up to 6 withdrawals or transfers from the account each month. They also have a low minimum balance requirement and typically do not charge fees if you maintain the minimum balance. On the flip side, as with any investment, there is the risk that interest rates could go down. but this is usually a minor risk. 6. Fixed annuities. These are a pretty safe option because they are backed by the insurance company that issues them. While there is always a risk of an insurance provider failing, the chances of that happening are extremely remote, and the insurance company must keep a reserve in the event of a default. Also, the principal invested is guaranteed by the issuing insurance company and cannot lose value unless the company itself fails. Furthermore, since the annuity payments are fixed, the investor knows exactly how much money they will receive each period, making it easy to budget and plan for the future. Fixed annuities offer tax advantages too, where you can defer taxes on the annuity payments until a later date, when it may be more beneficial to do so. Finally, these offer a degree of liquidity, as they can be surrendered or exchanged for another type of annuity at any time. 7. Real estate. It is a tangible asset that can be seen and touched, rather than a paper asset, which makes it pretty safe. It has a long history of providing returns to investors and is less volatile than other investments since it is not subject to the same extreme market fluctuations. Additionally, real estate can generate income through rent, and as the value of the property appreciates, so does the value of your portfolio. Real estate also provides tax advantages, such as deductions for depreciation, mortgage interest, and other expenses. Finally, it is a long-term asset that can be held for decades and passed on to future generations, ensuring that your wealth can be preserved for generations to come. 8. Gold. It's considered safe because it is a physical asset that can't be printed, devalued, or controlled by governments or central banks. Gold has performed consistently over the long term, making it a safe choice for investors looking to diversify their portfolios and protect against inflation. It is also a hedge against currency devaluation and a safe haven during times of economic uncertainty. Gold has a long history of being used as a store of value, so you as an investor can be confident that gold is totally safe. It is also highly liquid, so it can be easily bought and sold without sacrificing value. 9. Savings accounts. It is a type of deposit account held at a financial institution that pays interest on deposits and allows for withdrawals. They are typically seen as a safe investment because these too are insured by the FDIC for up to $250,000 per depositor. Another reason is that although the interest rates are generally low, they are stable and consistent. Finally, savings accounts are highly liquid, so you can withdraw your money at any time without any penalties or fees. This makes them an ideal choice for those who don't want to tie up their money in a long-term investment. You might already be investing in many of these financial instruments, but our hope is that through this video you might have learned about some more options which you weren't aware of earlier, or even if you were, you did not really give them a close consideration. We sincerely hope you found this video helpful, and if you did, kindly be sure to like our videos, share them with friends and family, and most importantly, please subscribe to our channel, so we can keep creating more such content. Take care and have a great day.